Natural gas futures briefly broke below $3 earlier in the session, just to rebound to $3.10 resistance right after notably bearish EIA storage report, which showed a much larger than expected injection of 48 billion cubic feet. This figure not only exceeded the consensus forecast of 42 billion cubic feet but also dwarfed the 5-year average build of 24 billion cubic feet for this time of year. On paper, the report should have pressured prices further. Yet, in a counterintuitive move, the market swiftly rebounded, climbing back toward the $3.10 resistance level. The surprisingly bullish price action, despite the fundamentally negative data, strongly suggests that the gains were driven by short covering rather than any shift in underlying supply-demand dynamics. Meanwhile, natural gas supply continues to outstrip demand, with U.S. dry gas production climbing to 108.4 billion cubic feet per day on Wednesday, marking a 3.4% increase from the same time last year. In contrast, total demand reached just 84.5 billion cubic feet per day, up a more modest 1.9% year-over-year, according to the latest data. The imbalance adds to the bearish outlook, especially as a rising rig count signals the potential for sustained high output through the third quarter. If Friday's Baker Hughes report shows yet another increase in active rigs, it could trigger a sharp sell-off next week, even with mid-August demand expected to spike due to persistent heat. Although the August 6-14 period may bring a warming trend, particularly across the West and East, traders remain skeptical that it will be sufficient to shift the prevailing bearish sentiment. The recent break in July heat during what is typically a peak demand window has dampened bullish enthusiasm and kept many buyers on the sidelines. Bearish momentum appears likely to continue unless a clear catalyst, whether weather-related or storage-driven, emerges to reverse the trend. On the technical front, prices are currently testing near-term support around the $3 mark, with the next major level sitting at $2.88. Overhead resistance remains firmly in place at $3.25 and $3.50, creating a significant barrier for any upward movement. Even if prices attempt a rebound, these levels are expected to limit gains and could trigger renewed selling pressure unless bulls muster enough momentum to break through convincingly. Unless bulls can decisively break through and hold above these resistance levels, the path of least resistance still points lower, potentially opening the door to another sharp leg down if the $3 support gives way. Please like, subscribe, and comment to support the channel. See you in the next one.